All right, let's dive into one of the most debated, most polarizing products in all of personal finance. Seriously, people either seem to love this thing or they absolutely despise it. So, on one side, you have a whole bunch of financial experts who are, let's say, extremely critical of whole life insurance. They look at it and see a super expensive, inefficient product that for the average person is just fundamentally flawed. But then you flip the coin, and it's a tool used by some of the most financially savvy people and institutions on the planet. We're talking banks, huge corporations, you name it. So, what is going on here? How can one single product be both a cornerstone financial asset and a total trap? Well, to get to the bottom of it, we've got to look under the hood. So, how can both sides of this fight be right? Well, the answer really starts with the unique and honestly often misunderstood way that these policies are actually built from the ground up. You see, unlike term insurance, which is temporary, whole life promises to pay out no matter when you die. It's a lifelong guarantee. But to make that work, they can't just charge you the real cost of insurance every year. No. Instead, the whole pricing model is, well, it's front-loaded. And this right here, this is the absolute key to the whole thing. The company intentionally overcharges you when you're young and healthy. That overpayment creates a big pot of money, a reserve, that they use to cover your much higher insurance costs when you get older. And that reserve, well, that's what becomes the policy's famous cash value. And just look at how massive that overpayment is. It's kind of staggering. For the exact same amount of death benefit, you could be paying 20 times more for a whole life policy than a simple term policy. And that huge cost, that's the engine that drives this entire controversy. So that giant price tag isn't just for the insurance itself. Nope. It creates this massive pool of money that then fuels how these policies are sold, which gets us right to the heart of that sold, not bought criticism. So you pay that huge first-year premium. Where does it go? Well, here's the kicker. Almost all of it, and sometimes, believe it or not, even more than you paid, goes directly to the agent as their commission. And that payout is just worlds apart from what they'd get for selling you a much cheaper term policy. You know, there's this old Upton Sinclair quote that critics love to use, and it just perfectly captures the problem here. The way these commissions are structured creates a massive conflict of interest. It incentivizes selling the most expensive product, even if a cheaper one might be a much better fit for the client. Okay, so now let's actually run the numbers. Let's look at how these policies perform as an investment for you, the person footing the bill. This is really where that trap narrative starts to take shape. Yeah, so those giant upfront commissions, they have a direct and pretty painful impact on your money. Your cash value can literally be zero in the first year. Your return on investment is deeply, deeply negative. As you can see right here, it can take well over a decade just to break even and get your own money back. And this chart just brilliantly shows the opportunity cost. I mean, even when your cash value finally starts growing, the long-term returns are usually pretty low. Think 2 to 4%. Now, when you stack that up against what the stock market has done historically, you're talking about a massive loss of potential wealth over your lifetime. Okay, so if the math is so clearly not great for the average person, why on earth are the most sophisticated investors and biggest companies using it? This brings us to the huge counter-argument, and it all boils down to one thing: policy design. Right, so proponents will argue that all the critics are just attacking a poorly designed high-commission version of the product. They'll say, hey, a policy can be properly structured to slash agent commissions and instead use extra payments called paid-up additions to essentially turbocharge the cash value growth right from day one. And in these very specific situations, whole life isn't being used for growth like a 401k. Not at all. It's used as a specialized tool for moving wealth around in a tax-efficient way. For the ultra-rich, that death benefit provides instant, tax-free cash to pay huge estate tax bills without having to sell off the family business or other assets. So, after looking at it from both angles, what we're really seeing is that the trap isn't necessarily that the product is a scam. It's more of a fundamental mismatch, a misalignment between a product designed for a super niche purpose and the financial reality of the person it's often sold to. You've basically got these three things all working together: the sales incentives, the high costs to get out if you change your mind, and the low long-term growth. They combine to create a system where a product designed for one very specific thing is often sold to people who have very different and usually much simpler needs. And ultimately, the whole story of whole life insurance forces us to ask this critical question about any financial product, really. Is this thing built to protect me, or is it built to profit someone else? Understanding the incentives and the math behind the curtain, well, that's the key to deciding if something is a powerful tool or just a costly trap for you.